you cause bodily injury or property damage to somebody, that's your liability insurance. So Fair Plan doesn't cover that at all. A lot of talk about people self-insuring now. They don't have a mortgage anymore. I'd strongly urge you to have liability insurance. That pays for your defense, whether you're being sued wrongly or rightly. Insurance policy pays for your defense. Then the difference in condition policy also covers those perils that the Fair Plan doesn't. So the main ones are theft, mold's a big one now, and water. Your water heater breaks, floods your house. So a difference in condition policy combined with it fills in what's normally in a homeowner's policy. It's a lot cheaper than the Fair Plan, but you can't have a difference in condition policy without a Fair Plan. 2 years ago, 23 total homeowners insurance premium collected for the whole state was $13.5 billion. The LA fires, let me talk to you a little bit about that, just to give you perspective. They're estimating the insurance losses are at $75 billion, and then all the way up, I've heard, to $125 billion. A lot of people are insured, unfortunately. Just to kind of put that in perspective, just doing simple math, if you take the 2023 premium, divide $75 billion by $13.5 billion, that's right away 6-7 years of losses. Complete losses for the homeowners insurance industry for the last 6-7 years. That means, so how many businesses can you operate at a total loss for that many years? So this is the biggest catastrophe for the insurance industry ever in the state of California. A few positives that were coming out. The three of them I was going to mention. One is the sustainable insurance strategy and the reinsurance market, and the third is non-admitted insurance companies. Earlier in the year, the Department of Insurance Commissioner, Laura, pretty much they were responsible for destroying the market in California, promised the sustainable insurance strategy. So, and he promised to get that done by the end of the year. So actually a week or two before the fires, they were finishing up the regulation. And in that regulation, it says that if an insurance company wants to sell property and casualty in the state of California, then 85% of their market share has to be in wildfire distressed areas. So Valley Center is a wildfire distressed area. The insurance industry has to increase every 2 years by 5% their market share. That's putting some serious pressure on the insurance companies. It's not going to happen fast. The insurance industry doesn't move fast. They're very conservative. As a concession to the insurance industry, and we had a lot of insurance companies leave the state, and that's a long conversation. I can go into the reasons why. But California is one of the few states that insurance companies could only rate the policies by historical data. So if a zip code had 2003 and 2007 wildfires, the insurance companies had to, if they wanted to write in that zip code, they had to black the whole zip code out. They had to base their rates on the historical data. They have tons of information now, hundreds of sources of information with artificial intelligence and data, and they look at density of brush, they look at wind patterns. It's all collected now on a computer. They were saying, hey, look, we want to write in a bad area like Valley Center. We want to write the good risk in Valley Center. We don't want to just have to say no to all Valley Center. So in that insurance, that sustainable insurance strategy, the insurance commissioner has agreed to let them use modeling now and not just historical data. Proposition 103 that was passed in 1988 gave the Department of Insurance the control over the insurance companies raising their rates. Somehow California is the only state in the nation you can't include your reinsurance costs. So when insurance companies go and they buy insurance on the insurance policy, your house is insured for $1 million, they're not going to pick up the full $1 million. You're going to get a check from them for $1 million if your house burns, but then they bought insurance on their insurance, and that's pretty much a worldwide market. Other insurance companies are going to kick in, and it's to save the insurance companies from getting wiped out. The state of California didn't let insurance companies, when they were asking for rate approvals, factor in their reinsurance costs, which is a huge expense. Sustainable insurance strategy is now letting them put those numbers into their request for rate approval. And the Department of Insurance has promised to consider rate requests faster. So during COVID, the California Department of Insurance didn't increase. They virtually did not approve any rate approvals. Even though if you had your car, you wrecked, and your car was $15,000, it was now worth $20,000. And so the insurance companies hadn't been able to adjust their premiums at all. If it was getting repaired, it was taking twice, 3 times as long in the shop to get repaired, and the labor to repair the vehicle was going up. And so the Department of Insurance didn't approve any rate increases for almost 2 years during COVID. So you had insurance companies losing money, and finally said, look, you can't force us to lose money, we're leaving the state. Second positive out there is the reinsurers, the insurance companies from the insurance companies. From 2017 to 2023, they increased their rates 100%. They hadn't raised, the rates had actually gone down for the 11 years preceding. So a lot of what started this non-renewal phase, the reinsurers should be pretty healthy now, and they actually lowered the rates a little bit last year. They had a 100% rate increase, which is causing a lot of insurance companies to raise the rates, or wanting to raise the rates, leaving California, other states they could. And then the third thing that we're seeing is non-admitted insurance companies. If a insurance company wants to sell property and casualty in California, they have to get approval by the Department of Insurance, and now subject to the Proposition 103, they can't raise the rates unless the Department of Insurance says so. If they want to raise it more than 6.9%, then they have to pay for a consumer watchdog group if they want to sue them. And that usually takes about 2 years in litigation. The insurance company is having to pay the watchdog group to sue themselves in the state of California. Non-admitted insurance companies, one that everybody has typically heard of is Lloyd's of London. They can sell insurance in the state. They're not subject to the 103 because they're not admitted. They still have to prove their financial solvency to the Department of Insurance. So we've seen a few carriers come into the area. Right now they're quickly getting saturated. They'll insure in a 3-mile radius, they might want to insure 2 or 3 homes, but they have the technology now, they don't want to insure 20 homes because there is a wildfire in that area. So what we've actually seen, we just signed an appointment with one this week. So I think that's kind of the future in California, but things takes a few years at the minimum for the industry to react and to get in. But when it's not admitted, they don't have to wait 2 or 3 years for the Department of Insurance to approve they want to modify their policy, they don't have to pay filing fee. One person asked me already, and I'll talk about the FAIR plan, do they have enough money? The first level, doesn't operate like a private insurance company where they have cash reserves and they have to make sure there's so much money set aside. FAIR plan is an in and out basis. That's how they describe it. They're evaluating right now. They already have over $1 billion in claims. The last numbers I saw, they were insuring 22% of Pacific policies, I think 16% at the time. So that information is going to be updated relatively. What happens with the FAIR plan though, they have some reinsurance. I've heard it's about $4.5 billion, which is not going to be enough. Third step that happens is they assess insurance companies, which is one of the reasons we had insurance companies sort of leaving also, because based on your market share in the state, so State Farm was the biggest, and they had about 22% of the property and casualty in California. So if the FAIR plan is underfunded by $5 billion, then they're going to go to the insurance companies and say, hey, you had 22%, you owe us 22% of the $5 billion, which is pretty scary for the insurance industry because they're not charging a premium on that. So what happens, you had a lot of the smaller regional carriers leave the state because that was just going to bankrupt them. That assessment is being talked about. It hasn't been done since 1993. Actually, about 6 months ago, the Department of Insurance Commissioner signed a thing that was going to allow the insurance companies, there's different formulas. I think if it's less than $1 billion, they could assess the policyholders at 55%. If it's over $1 billion, then they can assess them 100%. So possibly your insurance company could come back and every policyholder in the state could get a bill from State Farm to keep them solvent. Kind of picking on State Farm right now, they were the biggest loser in this wildfire. So they actually, and then there's been some press about it, like saying they're asking for an immediate 22% rate increase. That's actually one that was filed 6 months ago, and they're asking the Department of Insurance to make a decision now because their reserves are down. They're, I think, at 16%, but definitely less than 25% capacity. So the money that they usually keep on hand to pay claims was even before the fires was down to 16%, which is why they were downgraded by AM Best last year. So that's kind of an overview. Just to help people understand the severity of what's going on right now with insurance.
I tried to raise my deductible to $150,000, and all they would do is go to $50,000. That also included I spent about 15 grand putting in the wildfire protection certificate, which took me about 4 months. So what's going on with that kind of stuff?
If it's a submitted carrier, they
Farmers.
Okay. Department of Insurance has a lot of control over the insurance companies. If they want to make a change, they have to submit it. You know, and
That's stupid. That is just stupid.
Proposition 103 gave them a lot.
California
Department of Insurance.
I have one more thing.
Yeah.
They not only doubled my insurance from the middle of 23, they doubled it again. So it's 4 times what it was in the middle of 23. On top of that, I have this wildfire protected certificate, which is one of the things they require. And it's also the same thing as CAL FIRE does with AB 38. You have to have to sell a house down. So something's haywire with the insurance company. When do you think it'll sort itself out?
These concessions that the Department of Insurance made are pretty substantial. Letting them use the modeling, letting them include reinsurance costs. So, you know, quickly it would be 2 years, my guess, that they could actually implement these things. And there's a lot of hesitation, a lot of scary, like in LA, the not having water, fire hydrants. I mean, the insurance industry looks at that, and then the Department of Insurance Commissioner is going to change. It's an elected position. It's usually a stepping stone to governor or higher position. So, current insurance commissioner didn't have no insurance experience. For the severity of what's happened in the market is kind of what we're on. So, just trying.
Yeah. So if you have a question, please write it down. I'll come get it on the card. We have so the FAIR plan I read was meant to be a transitional coverage. I'm unaware of another alternative. The funding comes from the industry partners. Will they continue to fund this program?
It's supposed to be just to get you through temporary insurance plan. It was started back in the 60s after the Watts riots, and people in the LA couldn't get insurance access when they actually started the FAIR plan. I heard they had about 700 or 800 cash on hand. We're talking billions of dollars now, but there are bailouts for the FAIR plan. They're going to the insurance companies and assessing them. Commissioner Laura did say that the insurance companies now, if it's going to make them insolvent, that they can actually go to their policyholders and assess their policyholders. So I'm not sure exactly how that's going to work. Potentially every State Farm homeowners insurance could be getting that bill, you know, for an extra. Just as an assessment to keep us fair and solid.
Are we going to see our property insurance go up?
So what has happened in the last 8 months? The Department of Insurance has started to allow rate increases, and they're not making them go through the public hearings if it's over 6.1%. Yeah, most of the carriers, like State Farm, and depending on the type of insurance, but homeowners, I think they requested 28% or something. So they actually, in this letter they wrote, we can have it go to the Department of Insurance. We saw personal auto, they approved a number of rate approvals. They've really been turning them out now. We've actually seen signs of the personal auto insurance industry. I've actually had one company rep tell me, yeah, we have enough rate now. You know, so you saw like in the mid-20s, 20 to 30% rate increases for most of your carriers. So we've actually seen 3 or 4 companies that have closed their doors to California come back in. Property and casualty, the homeowners, just is a really bad situation. And now what happened in LA is yeah, it's really, really, really bad.
It's a game changer.